Hi, everyone. Welcome back to our podcast, The Ins and Outs of Selling a Business. For those of you just joining us, my name is kdee. I'm President of Osage Advisors. Osage Advisors is a boutique merger and acquisition firm working with business owners looking to sell. Typically, our clients have $5 million in revenues and up, and we are just celebrated our 21st year in business. So today we're going to continue our discussion on why deals don't close, why they bust, what the deal killers are. And last episode we talked about the main reason deals don't get done, and we kind of broke it up into 5 sections, 5 buckets. We had the financial performance bucket, we had the seller remorse bucket, we had time is never your friend when you're trying to get a deal done. Lack of transparency, mistrust between the parties, and maybe the management team or family deficiencies in their ability to run the company without you kind of steering the ship. So as promised, I thought we'd give some real life examples of how we were able to mitigate some of these risks in a way that satisfy our clients, because that's the main goal, is make sure they're happy. And also get the buyer to buy into these so they were willing to move forward with the transaction with some adjustments or some structure to it, as we call. And the first one really typically happens is the financial performance of a company. You put together the SIM, confidential information memorandum we talked about, or book, as we call it in the trade, and the buyer makes their initial offer based on those numbers, and after meeting with you, they submit a letter of intent, and they provide an offer that kind of lays forth, here's the price, here's the terms. And once they get into deep due diligence, things can happen in an environment that could cause some slippage in the numbers. For example, if they're basing their offer on $2 million of adjusted profits, supported by a strong backlog, a good pipeline report, good economic indicators in the environment, then everything's great. But what happens if things slip, right? So I'll give you an example. We were working on a deal that closed recently where the numbers were kind of holding up, but there's indications from a major customer that they're putting some orders on pause. And it was a substantial customer. So, and it wasn't like the work was going to go away. It was a critical piece of, in this case, a component. But they had some backlog issues on themselves. So they're telling the supplier, okay, hold on. We're going to put a pause on this for the next, 12, 18 months. So in the good spirit and faith of transparency, we called up the buyer, of course, with our client's approval and after discussion, and said, hey, I want you to be aware this is taking place with this customer, and how are we going to work around that situation? So the way we were able to satisfy our client, which was multiple families, and the buyer was, okay, based on where you are today, we're going to pay you X. And then when that contract comes back online over the next, in this case, I think it was 18 months, and you start generating profits, we'll pay you out on that. It's called an earnout, right? It's a structured payout. So what happened is that we were able to get the deal done with the buyer, and our client, the president, was in this case was staying on board through this earnout period. And once they were able to achieve, bringing that client back online and the profits, they get the remainder of the purchase price. Now, the jury's still out, of course. I mean, you got to execute. The customer has to, bring the work back in. If they don't bring it back in, then, obviously the price that the buyer paid was probably reasonable. If they do bring it back in, our client gets the benefit of that. So in this case, it's a win-win. And believe me, the buyer wants that business back because it's only going to increase their value long term. So we had to satisfy both parties, and not just one party, one buyer, one seller, but the seller had multiple family members involved with this that everybody had to, sign off on. It took a lot of conversations and discussion, and we kind of like, what do you want to do? I mean, the choice was, hey, we can pull back, continue to run a company. That's your choice. Or we do the deal now. The president, who's been running the business for a number of years, stays on. In this case, he is kind of still steering the ship to make sure that that business, when it comes in, is still profitable and they get paid out. And that was a decision they had to make. Now, we could recommend one way or the other, but look, you guys have got to make a decision. How do you want to move forward? And they chose to move forward. So it satisfied, both parties. We had another deal a few years ago where the numbers just came in short, right? There were some production issues on the floor. They couldn't get the product out, and the buyer was concerned that they were going to be not going to make the number, right? So same kind of situation. It had nothing to do with, in this case, that the customer put them on hold. It's just there were some production issues internally. They had a couple of machines down, so their capacity, to do the work dropped like 35, 40%. They had to bring in someone to fix the machine. It took 2 months. They brought a new machine in on top of it, which was late. So it was just kind of all these little compounding issues that happened, real life stuff, right? It happens all the time. So the buyer's like, look, you got the work. We're going to help you resolve some of your production issues because we're going to bring some talent in to work with you on this to kind of streamline things. You got the new machine in, even though it was 3 months late, but it'll be up to capacity. So look, we'll pay out what we have today. In this case, it was, it was a couple, $3 million of profitability that, or value, transaction value that was kind of, pushed off into an earnout. But, the three separate partners, three separate families said, that makes sense. That's realistic and acceptable. So in that case, we were able to work through, the logistics and issues that transpired. It happened every day in business to both parties' satisfaction. Again, it was totally open and communicative with the buyer. So they were kind of like a partner in us to kind of how are we going to make this work? And that was a win-win situation for both parties. Now, we have another deal that, some of the trend lines, even though their profits are good, the unit sales, so to speak, are down. And even though from our seller perspective, it's like, okay, I'm making more money on this stuff, even though I'm selling less of it. So actually, it's a good thing, right? But the buyer looks at it and said, well, we're betting on the future, and if your trend lines are down with this unit number, so to speak, we're concerned what the future hold, because we want to take it from 5x to 15x, in value. So, the jury's still out on it, but we've kind of reworked the structure of the transaction from an ownership perspective. So my client is much more committed from an equity perspective. Like I am confident we're going to do this, and I'm willing to put my cards on the table to show you we can do this. And I'm going to stay on over the next, 3 to 4 years to prove we can do this. That gave the buyer additional confidence or renewed confidence. Okay, you know what? We're going to hook our horses to your wagon, because if you're willing to do that and you're committed to that, we're coming along for the ride. Okay? So, but who would have thought that even though you're making more money on selling less would be an issue? But it was. But we found a solution. Now, again, my client was committed to it. I mean, the alternative was, I hear what you're saying. Let's wait 6 months. I'm going to show you how I'm going to do this, then we can re-engage. But the thought was what the buyer could bring to the table today versus 6 months or a year from now. The added value they can bring, the Rolodex they can bring, the financial strength they can bring was worth making that additional commitment from my client side. He bought into, you know what, this is the time to do it. Right? So we had options. Wait 6 months or a year to go back, frankly, go back to market, or work with these guys, this firm, who he liked, which is important, and moving forward. So, those are a couple of examples from a financial perspective. From a seller remorse, we talked about that, right? Do I really want to do this? And I'll give you a couple of situations, right? And we worked with a company a couple of years back. Two brothers owned it, and they engaged us to sell. And we were like deep into due diligence. And they asked me to lunch one day, and I went to meet with them, and we sat at the table, and I said, look, I'm sorry to tell you this, but, I'll call him, Bill, he doesn't want to sell. That's your prerogative, right? So, it turned out that the older brother was committed to this. The younger brother didn't want to upset his older brother, so they really didn't talk about it. But at the end of the day, he said, I just can't do it. I want to continue doing what I'm doing. I'm not in the same mind frame or age bracket that you are, and I got another 5-6 years of wind in my sails before I retire. Totally out of our control. Kind of caught us by a bit surprised because you thought that everybody's in sync. But, as you go through it, the emotions rise. And in this case, the deal didn't get done. Not because anything, just it personally just couldn't let go. So the other brother sold out to the younger brother, and that was the story in that one. Another reason is from a seller's perspective is if you don't test the market, if you don't do an auction, if you don't work with a firm like Osage, and is this the right value, right? Is this what I'm getting? We all have our network of friends and peers we work with, and there's a lot of quote-unquote noise in the back. You're getting people calling you, or, hey, Jimmy, I did this, and this is the value I got, and don't watch out for this, and be careful of this, which is all fine and dandy, but, their company's totally different. I can tell you, we've been in business for over 21 years now, and we've never seen two transactions exactly alike. Everything has a different twist to it, term to it, etc. They just don't, they're not the same. So when you're talking to a business owner, we had it the other day with a client that we sold, where we're like literally the night before closing, and I got a phone call at like 8:30 at night. And our client was like, well, I told from my buddies, you got to watch out for this. They don't want to pay the earnout. They don't want to do this. And I said, why would they not want to pay you? They want you to earn the money, right? And if you earn the money, that's more value to them. It's a win-win for both parties. So, and I explicitly mentioned to our client that we covered this in the asset purchase agreement. And we said, this is the calculation for the earnout. But he wanted more comfort, confidence in that. So I was out to dinner when he called me. I got home and I emailed the buyer, and I put specific language that needed to be in an email. They didn't have to be in a contract. Just, we were so far down the line. Just please, reinforce the fact that this is how it's going to work. Okay. In this case, it was a thing where one of his buddies told him they're going to throw all a bunch of corporate overhead down to your business, so you'll reduce your profits and you won't make your earnout payment. And it was explicit in the agreement that was not going to happen, right? Black and white. But I asked the buyer, can you send an email? And he did. And then I got the email. I forwarded it to my client. I got on the phone with him, and I said, does this work for you? And he said, yes. And that was the night before closing. So, sellers mainly are, they're inundated with their family, their friends, their peers, right up to close about things they got to think about. And I always try to bring them back. We always try to bring them back. It's like, okay, what motivated you to come see us in the first place, and what your goals, objectives were? And if we have met those and you're comfortable with them, then things will work out. We'll move forward. If there's some concerns regarding those, then we should step back and wait. Right? It's got to feel right. It's got to work. We've talked about this many times before. But when it comes down to that seller remorse bucket, those are the type of things that are ongoing that need to be addressed to our client satisfaction, which we did in this case. Now, in another situation several years back where we were right there, literally, I'd say a week from closing, my client called me up and says, I don't feel good about it. And I said, why? I said, because I think what I've learned from this transaction, I can put those in place and I can build my business by 25, 30% and make more money and go back to market down the road. And I said, if that's how you truly feel about it, then don't close. Again, we're relationship driven. We want to listen to our clients. We need to process it internally, and we need to have an open, honest discussion. So what did my client do? He called off the deal. He just didn't. He felt that he was shorting himself in value. He was young enough that he can put some more time into it. It didn't close. Nothing we didn't do wrong, right? And other firms too. They run through the same issue. That he just couldn't do it. He felt he can build his business based on what he's learned through his market analysis, and build value and go to market in a future date, which is planned. So, the other one is really time. We talked about time, right? Time can kill all deals, i.e., we've had 2 deals, that one's still on hold, from COVID. Just the industry they're in is, it's taking a long time to come back. I was on the phone with an equity fund. I think it was either last week or the week before. They closed a deal in the hospitality or leisure field, a big deal for them, the week before COVID, right? If for some reason things were to, and so the seller was happy. The buyer, things are coming back now, but they had to support this business. It was on life support for 18 months or so. If the seller, for any reason, delayed things because of concerns that weren't properly addressed through the due diligence process, and it was one more week and a day, then nothing. It would have stopped the deal, right? The deal would have been done, and he would have been probably in a situation where he would have to go into his pocket to keep his company going. Obviously, there was government funding and everything else, but still, at his age, did he really want to be in a position where he had to basically refund his company to get him through God knows how long before the business came back? We had another situation, and it came down to an environmental issue, right? And it's really important, especially manufacturing, of course, is that you address environmental issues head on. We prefer prior to engaging with the buyer pool, so at least we have a phase 1, so we kind of know the landscape. But we were in a deal where, unbeknownst to our client, unbeknownst to us, and unbeknownst to literally the Department of Environmental Protection, that there was an outstanding issue that was never closed from 15 years ago under different ownership. And no one knows where and the buyer, who was a public company, was not going to close on this transaction until there was some kind of resolution, right? So we had to go through our lawyers, environmental team, had to find somebody they knew at the Environmental Protection to search us out. They found it in some box in the corner. It just never got closed out. Okay, it wasn't a huge issue, but it was important. The buyer's never going to put themselves at risk of environmental issues. So the solution is that, okay, we're going to set up an escrow. So we're going to put money in an escrow that we felt was more than adequate to cover if there was a cleanup issue with this outstanding, unresolved environmental issue with the land. And the buyer and the seller agreed to it. Now, this didn't take like a week, right? This took delayed the closing for 2.5 months. So we closed on a Friday. On Monday, this public company gets a hostile takeover offer from a bigger company. If it happened 2 days before, they would have dropped this thing like a rock, and they would have focused totally on defending themselves, right? So we were very fortunate to come up with a solution between the buyer and the seller, set up the escrow, fund it with a dollar amount, and, it worked out well. But if we didn't address it properly, if we didn't bring it to the forefront, if we didn't get everybody at the table working together to find a plan that would work for both parties, that would have killed the deal. It never would have closed. Management. We all work as family companies. Our clients, typically have a management structure in place, whether it's other family members, whether it's an outside person who's the COO or head of sales, things like that. So the issue we ran into with the deal recently was that our client thought the person that was going to take over for him was the right person. When we got deep into due diligence, the buyer felt that they weren't. So they literally walked away from the deal. That we can't back this. If you're not going to be here, we can't back this guy. So we said, okay. So clearly they weren't the right buyer because they didn't have a team in place to replace this person. So we went back to market to a backup buyer that was part of this process. And he had the skill set. He had the team in place that this was not a major concern. So we were able, even though the deal broke with one party, we found another party. Okay? Those are the type of things that our job is to happen. Finally, I think the key thing is transparency, right? Communication. If everybody's stressed, the seller is stressed, the buyer is stressed, everybody's working under a lot of stress to get the deal done. There's been a lot of money, a lot of people involved trying to run your company, trying to get a deal done. The buyer, they report back to their own committee or CEO where we stand. So having an open line of communication is critical. I mean, I know, I'll just give you one quick example. We had a deal last year where I got an email at, 6:30 in the morning saying, how many books did we put out and how many bids do we get? That's all it said. And we were supposed to close next Wednesday, right? And so I knew my client had a bad weekend. He was unhappy about something. So I called him up immediately, like 7:30 in the morning. And I said, well, okay, what's going on? Well, they said they're going to do this and do that, and they didn't do it. I'm done. I said, okay, let me go back to them. All right. So I called up the buyer and I said, hey, my client's unhappy. You were supposed to produce this, and that, and you didn't do it. So, we took care of that on Friday. I said, well, you think you took care of it, but in his mind, you didn't. So my suggestion is call him right now and get it taken care of. So they put a call into him and everything was fine 2 hours later. But that miscommunication, right? That's part of our job is make sure that communication is open, honest, and continues to flow. Because if there's any miscommunication, misunderstanding, that could lead to the deal being, collapsing and not closing. So that open communication, transparency is critical, probably the most critical thing of all to getting a deal done. So again, here's, the 5 buckets of why things don't get done. We talked about financial, seller remorse, time, lack of transparency, and management. But there are ways to satisfy both parties to get the deal done. And that's part of our job when we represent our clients. My name is Keith D. I'm President of Osage Advisors. Thank you for joining us today. You can visit Osage on our website at osageadvisors.com. Feel free to email me at kdee@osageadvisors.com or pick up the phone and give me a call anytime at 860-767-3273, extension 1001. Thanks for everybody. Have a great day.